Okay. Hey, good afternoon, everyone.
Hi, Professor.
Hi, how are you, Sadie? Hi.
I'm
Um,
good.
good, good. Okay, so people are beginning to join. Now, looks like I have 7 people here, and let me check. Uh, let's check where. Okay, where is it? Discussion board. Okay. This again. It should be only 10 items per page. Okay, so looks like I'm having yeah 8 people now. I mean 7, I mean except except myself. It's got to be 7 people. So 7 and 7 on both in both rooms. So okay, I just sent out. I believe I sent out an announcement, a new message in the announcements today. Wonder if you guys have got it. I already posted the instruction for uh, homework 3, right? Now, so uh, in the book, it's homework 3 is like chapter 16. I don't know. It doesn't. And also, if you don't have the book, and it's going to be due Monday, so you have this weekend to work on it. And if you go to the assignments, homework 3, screenshot of homework 3 is there, right? Actually, it's not that many problems, and uh, you just need to. It's not really that many problems, but you just need to follow the format uh, taught in class. I mean, it will be a lot easier compared to homework 2. Uh, it's a lot easier at this point. I mean, because time value of money requires a lot of thinking, and without sufficient training, it's hard to tell whether it is the question about the future value of annuity or present value of annuity, or whether it is about uh, the payment, or whether it is about the annuity, right? In other words, whether it is the present value or future value, or whether it is about the payment, right? The annuity itself. So it requires a lot of thinking. Compared to that, um, a uh, financial statement would be more just mechanical. But then that's only the way uh, the way the problems are set up. I mean, you can make it more. Um, that requires more, logical reasoning and analytical reasoning, and that part, there's that part. It's just not in the homework. So we're gonna talk about that today. And besides, we'll have to wrap it up. So I have 8 people now here. Okay, and I should hopefully, the rest of the class will join us very soon because I don't want them to miss this. Alrighty, so yesterday, uh, I think we were talking about, uh, the difference between the uh, promissory note and invoices, right? I mean, invoices, I told you, promissory note is like it's accounts receivable. Think about it. You didn't receive it, but the reason they uh, we talked about it's not working. What's going on? Okay, another thing is giving me a hard time. Let me try again. Okay, so it's not responding, so I'll just open up another one. So we know quite well what a promissory note is, don't we? Because what's going on here? We already know, if you think about it, we already know a lot about the promissory note because we talked about it in topic one. What did we do in topic one? If you think about it, the topic one was about it was about discounting promissory notes, isn't that right? Simple interest and simple discount, right? And what is the simple discount all about? We did simple interest. We did simple interest all because of simple discount. Because I've been telling you, in the short-term financial market, you don't use simple interest rate in the long-term financial market, right? Simple interest rate is used only in the short-term financial market, and in the short-term financial market, it's mainly in the short-term financial market. The interest rate is used for discounting. Discounting what? Discounting promissory notes, right? Remember that? So the topic one was all about simple discount. Because in the okay, what the? All right, simple discounting then. Simple discounting of promissory note, right? So we talked about promissory note even in topic one, and in the short-term financial market, basically simple interest rate. You don't in reality, you don't find you don't do this. I mean, it's not. This is future value using simple interest, but in um, this is rare. I mean, it's not completely non-existent, but it's rare. Mostly, simple interest rate is used for discounting, right? Uh, I mean, the simple interest rate principle, it's used, mainly for discounting, um, to be used as the discount rate for promissory notes. This is the face value of the promissory note. And if the promissory note has interest, yeah, it's going to be like this. If the promissory note doesn't pay any interest, so it's going to be like this. So you remember the non-interest bearing note? Non-interest bearing, discounting non-interest bearing note, and discounting interest bearing notes, right? Interest bearing. Okay, so we know what promissory note is, and I yesterday what oh, I need to just add one. Okay, so and so what I was talking about yesterday was that isn't promissory note a kind of accounts receivable? Yes. Think about it. You didn't receive payment. You received the payment in form of promissory note, but you didn't receive cash. So you still have to collect the payment, right? You still have to, when you hold the promissory note, you still have to collect the. But you don't have to wait until the maturity. You can always take the promissory note to the bank and discount it, right? That's what you already learned in topic one. Um, so that that process is also called factoring. Discounting the promissory note is also called factoring. And I told you, factor refers to like that financial company that specializes in discounting the promissory notes, right? So a bank does that too. So a bank is a kind of factor, but there are financial companies that specialize in this. Uh, but then, why is it so? And then think about it. Invoices, and I was talking about what I was talking about was uh, the promissory note is accounts receivable, also kind of accounts receivable. But why do they have accounts receivable as a separate item, right? Ever wondered? Ever wondered why? Huh? Because take it as a rhetorical question, because I'm not expecting you to really answer it. But some people may. I mean, all these videos are released. My lecture videos are basically released in advance. So if you were sticking to the schedule, you have studied it already. You have watched it already, so you should know. But then apparently, not too many people are really watching it. You understand what I'm talking about? Huh? A lot of people think, and a lot of people think that the collaborate session is the main lecture. I've been telling you, no. The collaborate session is only the reflection, right? Review, reflection, and review, not the main lecture. Main lecture was the main lecture is conducted through these um, lecture videos. They are um, released in advance, and unfortunately, all of them are already, passed, right? Last available on August 8th. So then, if you missed them, right? If you didn't watch them uh, on time, then what you can do is you can go to my YouTube channel, and it's there. It's all of them um, in exactly in the same order as this, as we go through, exactly in the same order as our uh, the layout of our syllabus, the order, the sequence in the syllabus and in this. So according to that, then think about it. Now, even topic 4 and 5 folders are open. They are visible. Even topic 6 folders are visible. And what does that mean? Actually, they are. And even this one, overhead, they are already passed. The last day it was available was August 10th. So that means, currently overhead and inventory, these videos are still active. Okay, good. These videos are still active. That's good. And depreciation is also active. So at least, if you're keeping up with this, these are the main lectures, not, collaborate. Okay, and whatever you have missed, whatever is no longer available in the Blackboard, it's on my YouTube channel. Okay, over and over I've been. So no, why is it not working? So I'll have to rely on. Okay, and then this was it. So the question was, why is the promissory note a separate line item from accounts receivable? I mean, I've been telling you, still promissory note is pretty much like, accounts receivable. But the reason they are separate is, accounts receivable mean that most of the accounts receivable are invoices, right? Invoice. But then promissory notes, but even if most of the accounts receivable are invoice, but if the promissory note is also a kind of accounts receivable, can they be under the same umbrella? Yes, they can be, but there's a reason why they set aside the promissory notes. Why? Because promissory notes, I told you, promissory note and accounts receivable both represent credit sale. It's credit sale, literally, because you didn't receive cash for selling something, right? So it's a credit sale. Although promissory note is a credit sale initiated by the buyer, while the accounts receivable is credit sale initiated by the seller, because invoice is basically the credit sale initiated by the seller, right? You ship it to the your client without demanding payment at site, right? Without immediate payment. On the invoice, please pay within 5 days, within 7 days or 7 business days, 2 weeks, 30 days, So you gave them, you initiated, the seller initiated the credit sale, okay? And promissory note was imposed on you by the buyer, so it's a credit sale initiated by the buyer. But other than that, but even if that's the case, still, promissory note is still a kind of accounts receivable, but why not under the same umbrella, right? The reason is because promissory note, without selling anything, right? You can sell promissory note itself. You understand? And when the promissory note is sold for not a promissory note, think about it. You think that the promissory note is what a buyer a buyer issues when they buy something, right? Promissory note is in business to business. Uh, Promissory note is issued by the buyer when they buy something from the supplier, right? So it's B2B situation. Um, so that's usually the case. But without buying anything, without buying anything, um, uh, they can sell promissory note in the financial market, right? In the short-term financial market, so in money market. And sell it, when they sell promissory note, uh, and why do they sell promissory note? If they sell promissory note in the money market, then it's purely for borrowing money short term, purely for borrowing money for short term. Then it's called commercial paper. Commercial paper is a short-term bond sold by companies. So, uh, in other words, the company doesn't have to buy anything from the seller, right, to issue promissory note. They can issue promissory note just for the sake of selling promissory note. And just by selling promissory note, they borrow funds for short term. And that's why, think about it. That's why it is called, that's why um, if you sell promissory note, now this thing is not working again. I don't know or maybe I was something, uh, I don't know why. I don't know, something's wrong with that app, so I'm gonna go back to Canvas. Okay. Again, okay. Now uh, so the point is, then by selling promissory note, um, because when you sell promissory note, you're paying interest, right? So that's why they are buying promissory note in the money market. Uh, so it's a way of short-term financing, borrowing money for short-term, right? And whoever buys the promissory note will receive uh, the full face value of the promissory note, right? So it's going to be more like, but it can be either this way, it can be either this way, or it can be either non-interest bearing, but then it gets discounted, right? It gets discounted. Where's the undo? Right? So if as commercial paper, it can be interest bearing or non-interest bearing. If it is non-interest bearing, you pay only this, and at the end you receive this, right? So that's why promissory note is a separate line item from accounts receivable. But if it is about really promissory note that you received for selling your product, selling your goods to your buyer in B2B, yeah, then in that case, that's really accounts receivable. But again, now think about it. Um, Discounting the accounts receivable, discounting, we know promissory note will be discounted, right? Like this, when you receive the promissory note and you can't hold on to it anymore, right? And it could be either uh, just the principal or future value, right? Um, uh, you take it to a bank and factor it, discount it, right? And I told you it's called factoring. Well, where did the word factoring come from, right? Factoring. Actually, factoring came from the French word facteur. Facteur is mailman. Uh, it came from the French word la facture, which means invoice in French. And in Romance languages like Italian, Spanish, it's pretty much the same. In Italian, it's like il fattore or fattore, it's something like that. I think in Spanish it is also called, factora or something like that. Also, it's not. When I went to Czech Republic, right now it's called Czechia. Even in the 80s, it was called, Czechoslovakia. Now, Czechia and Slovakia are two different countries now. So, um, Republic of Czechia, I think, or Czech Republic. I went there, and they are using it's Slavic language because they are uh, most of the Eastern Europe is Slavic. So Czech is Slavic language, but even in Czech, invoice was faktura, invoice, right? Interesting thing is, in other Slavic languages, it's not faktura. Russian is not. German is clearly different, but Czech, it was faktura. So think about it. Where did the word factor come from? Factor actually came from these words, and it got anglicized and became factor. And now factor means, in English language, factor means the financial company that specializes in um, doing this, right? Discounting, the invoice and promissory notes. So the invoice, right? Um, it it originally it originally meant invoice, right? It originally meant invoice. So then think about it. So that's originally the way the invoices were discounted, right? Companies cannot suppose uh, I shipped out $50,000 worth of merchandise to uh, my uh, client, and together with my when you ship out something, the invoice goes together with that. In B2C, in a B2C market, uh, invoice is only a formality, isn't it right? In B2C, when you already have paid, actually, isn't it right? You buy something on eBay, right? And when you buy something, you have to, pay. If you don't pay, they will never ship it to you, right? So you pay with credit card, so payment is already made. There's no, so in other words, they already received payment, but when they ship it, always, what comes with the what comes with the your merchandise, the item that you bought, is the invoice. An invoice is basically a way of saying, please pay this, but you have already paid it. You have already paid for it. Well, why do they send invoices? It's just a practice, business practice. That way they match the invoice with the payment, I mean, it's your copy, but they have their own copy, so they match the invoice with the credit card payment you made. Um, so in B2C, invoice means not much. It's just a formality. But in business to business, invoice means something. It's a claim to payment, right? I shipped you this good, right? So please pay this. I have claim to the payment, right? That's the meaning. Uh, and then, so if you have this invoice because you shipped it, you shipped the good, the copy for the client went with the shipment, but your copy is with you. So then on the invoice you said, please pay within 30 days or something like that. But you can't wait 30 days. So what do? You take it to the bank or the factor and discount it. So you get the cash, in advance. And the bank will later collect it from your client who got the, good ship too, right? Okay. So that's the difference between, invoice and a promissory note. Okay. That brings us back to, okay. Okay, I hope you haven't lost the perspective. And where am I again? So here, still 8 people. What happened to the rest of the class? This is only 8 people. I always have something like 15 people, at least 15 people or something like that. Almost half the class is not here. Now, therefore, it's not a difficult thing. So we now understand what, and so basically that's the composition of the current assets, right? Of course, inventory. If you're a manufacturer, inventory consists of raw material, goods in process, and finished goods. If you're a retailer, only finished goods. Okay, and we can simply using AutoSum. We can find. What about the non-current assets or physical assets? Of course, the same thing, right? You use AutoSum, but what is depreciation? Again, we all understand what depreciation is. It's the decrease in value with the usage of the equipment, right? Everything, because everything wears and tears with usage, right? If with usage, the value has to go down. The value of the asset must go down. Isn't that right? An asset is what? Okay, I probably forgot to mention this. What is the definition of asset? What is the definition of asset? Asset can be defined on 3 levels, right?
Liability.
Yeah, someone.
Liability plus equity.
Yeah. Liabilities.
Liability. It's
okay.
Equipment.
Someone already.
A plant.
One at a time, and please complete it. But someone already said liabilities plus equity. Who said that? Shirley. Okay, Shirley.
It can be the value of something, right?
It can be what?
The value.
No. Yeah, everything has value, but just because something has value, does that make it an asset? Uh, I mean, your money has. If you have $100 in cash, yeah, the cash has $100 value. Yeah, you can call it asset, but I mean, uh, but surely I'm gonna first, surely I'm gonna give you 0.5. Uh, well, first of all, in accounting, they define it as liabilities plus equity. Uh, but this is called accounting identity or accounting equation. It's called accounting equation. It's just showing you where the assets came from. This is the uh, basically where where the assets came from. Assets came from liabilities and equity. In other words, our capital goods, right? Plant and equipment. Plant and equipment. If it is $100 million worth of plant and equipment and working capital, if that is $100 million, they originally came from liabilities and equity or debt and equity, right? So liabilities and equity is the source of the capital, and the assets are the use of the capital. How that capital raised, that $100 million raised through this capital source, which is equity and liabilities, how it is used or in what form they are held, right? In what form they are held, or how they are used. But that's only one definition. Second way of defining it,
Plant,
second, hmm?
plant and equipment.
uh, yeah, it's a type of asset because plant and equipment is uh, part of it's a physical asset, right, or non-current assets or real assets, right? It's just a type of asset, but that's not the definition I'm looking for. The definition, second level of definition. This is what the accounting does. A lot of times, accounting defines it this way: assets are what you own, and liabilities are what you owe. Okay, but then the problem is you cannot simply define it by own and owe, because own versus owe, uh, because liabilities are clearly what you owe, and who is you in this case? Who is you? Hmm? When we say assets are what you own and liabilities are what you owe, who is you exactly?
The client?
What?
Is it the client?
Client? So then, does the client own your asset?
A business.
Yes. It's two ways to look at it. It's the business, the company. It's what the company owns. Assets are what the company owns, and liabilities are what the company owes. But then also you can think of it this way: who owns the company? Who owns the company then?
The shareholders.
The shareholders. Yes, the shareholders own the company. So then, uh, because company is nothing but a vehicle. If you think about it, company is nothing but a vehicle. Eventually, a company is owned by the shareholders. So, um, when we say who owns assets are what you own, who is that? You, shareholders, right? Eventually, the shareholders. But initially, you can consider that as the company, and uh, So then shareholders owe the liabilities to the lenders. Actually, shareholders as a person, as a private individual, no. But shareholders as the representing the company, right? Uh, uh, so if you are looking at it from the shareholders, equity is not what you owe, right? Because equity came from the shareholders, right? So equity is what you own, free of debt. So if you define it as what you own and what you owe, from the owner's perspective, it's not completely, it's not entirely correct, but it is correct if you look at it from the company's perspective, right? Because from the company's perspective, assets are what the company owns, and liabilities are what the company owes to the debt holders or creditors or the lenders, and equity is what the company owes to the owners, right? But again, this is really, we all know, company is only a legal person. Legal person means it's an inanimate entity. It's not a living, breathing person. It's only a legal entity, legal person. So company doesn't really own. The company really doesn't own anything. I mean, it owns on the paper, right? Legally, it owns something, but eventually, because a company is owned by the shareholders, right? Eventually, everything that the company owns is the shareholders. Now, of course, the shareholders cannot uh, uh, just uh, do whatever they want with the assets. I mean, if every shareholder agrees, if the board of directors, right, basically uh, from board meeting, if they all agree to sell some asset, sell some asset. What does that mean? The company has idling plant or idling equipment that's not making money. If it is idling and not making money, it's actually losing money because you still have to pay for it. There's a cost to maintain it, right? So that kind of decision is a collective decision. One single, uh, uh, one single owner. I mean, think about it. I'm an owner. I'm one of those so many owners of Google, and I'm one of so many owners of Apple. I'm one of so many owners of Amazon. But my decision, I cannot make a decision on behalf of all the shareholders. If Amazon wants to get rid of one of its warehouses somewhere, I cannot. I have nothing to do with it. It's the management will make that decision, right? And the management was hired by the board of directors. Board of directors will represent the shareholders, right? So when they say assets are what you own and liabilities are what you owe, uh, uh, the subject of the sentence, when you say you, that you means the company, right? But once again, I'm going to come back to this because there's a little, we need some more clarity about that. Now, on the third level, so the definition of assets on the third level, because my question was, so what is the definition of asset? How do we define asset? One way to define it is the first one, assets are liabilities and equity. Second, assets are what you own, what the company owns, and liabilities and equity are what the company owes. Third, assets must have income generating power. Assets must have income. Assets must generate income. Assets must have income generating power. Okay? Now, think about it. Someone said assets are something that has value. That definition, not entirely wrong, but not entirely. Uh, I mean, if it is worded this way, if it is worded like asset is something that can create value, right? Um, then it may sound, it's a better definition. Why? If you have $1,000, of course it's your asset because it's your cash, which is part of the current assets. Um, and then cash can generate income. If you think about it, cash by itself doesn't generate any income. If you're just holding cash, it doesn't generate any income, right? It's still part of the current assets. But if you put that cash into stocks and bonds, then it adds value. It generates, because at least it, if you put it into bond, it generates interest. If you put it into stock, it will give you capital gain and dividends, right? Which is called investment income. Of course, it can give you a capital loss, right? But still, if it pays dividend, it still generates income. So,
So, sir,
yeah.
that mean that I'm getting my point. So you say there was right answer as well. So that's me.
Uh,
Thank you.
no, no, I'm not. Honestly,
Yeah, you say that it was right too. So yeah.
no. It's not entirely. It's not entirely right. As I said, if it was worded that it's something that can generate value, right? I would buy that. But you said it's something that has value. Hmm.
Yeah, but I also give you the business and the chill holder. So I have two more answers.
Oh, yeah. For that, yeah. Definitely. For that, you got 0.5 for each. So Harold, uh, you got one point. Okay. Um,
Thank you.
you're welcome. Now, um, so income generating power. That's a very important concept. Income generating power, right? It should generating. Uh, so and you understand assets. We already know assets break down into current assets, which are also called liquid assets, current assets and non-current assets, right? And current assets also, cash. I'm not going to go into that. Non-current assets, but the question is, non-current assets or physical assets, real assets, which are basically plant and equipment, right? Land and building. Non-current assets depreciate. They depreciate. They will have to depreciate if you think about it. Current assets, no, right? Uh, cash may lose value when there is inflation. Cash may lose value. Think about it. When there is inflation, cash loses purchasing power, right? And stocks may lose value. Stocks may lose value, right? Because there's a massive sell. There's a massive selling of that stock in the market, so price may drop. But that's not called depreciation, right? Now, what about the but current assets are generally um, short term, so uh, they all they can easily be turned into cash within 1 year, right? I mean, it's faster. I mean, cash is already cash. Stocks and bonds, instantaneously, almost. You sell it in the, you have stocks, you sell it in the market instantaneously. Accounts receivable, promissory notes, yeah, it won't take more than a day. I mean, you just have to take it to the bank to sell it, right? Uh, and if they lose value, for example, due to inflation, if they lose value, it's mainly due to inflation. The pi, Greek character pi, is the symbol for inflation in macroeconomics. But it's, so due to inflation, so it's, not, it's not that significant, I mean, it's not like losing, 50% due to inflation. I mean, in some economies, some countries where the inflation is crazy, yeah, it can happen. But depreciation means the depreciation decreasing the value of physical assets like plant and equipment. And why do they lose value? Of course, these are long-term assets. In other words, plant and equipment have service life of at least something like 15 years. Plant and equipment, they have service life of 15 years. Company vehicle, the company cars and trucks that the company owns, right? Now think about it. They are business assets, isn't it right? So they are also fixed assets, non-current assets. Company cars and company trucks are business assets. Trucks, definitely, you use it for business because you use it to ship, or these days, they want to streamline their fixed assets. So they want to minimize the fixed costs. So you don't have your own truck. You use, I mean, trucking companies, right? You use trucking companies. In other words, you outsource. But if the company has trucks for their own, transportation of shipping of their goods or whatever, for whatever reason, if it is a construction company, construction equipment is definitely right. Construction equipments are always a vehicle, right? Like bulldozers or power shovels. They're on track wheels, right? They're on track wheels, like tank, but they move around. Now, company cars, they are business assets as well. Why? Because company cars are used to give a ride. If you have important client coming to the company, you send out the company car to the airport, and you chauffeur them around, right, while they are in town visiting you. You give this courtesy to your client. So they are all basically contributing. They are all contributing to generating revenue for the company, isn't that right? So these are business assets. But think about it. They all wear and tear. The depreciation comes from wear and tear. Okay? And wear and tear comes from usage. As you use them, right? You say they get old. But getting old means wear and tear. Right? Everybody understands, the cars, you had a car, I mean, you bought the car 5 years ago. When you bought it, it's brand new, mint condition. And as time goes on, as you use the car, it adds mileage, and as mileage goes up, as mileage adds on, the car will have some signs of wear and tear. some some chips on the paint, dent or scuffs on the paint, some fender bender, or they will have signs of wear and tear, age. And it's not only the outside, it's not only the exterior, but also the engines will have the engine will have the effect of wear, right? Everything, the car seat and everything. So the value, it's only natural that the value should go down. All the fixed assets, physical assets must have, the value of physical assets must go down, reflecting that aging, right? Which is basically wear and tear, right? But then you might think, oh, okay, so what if I take a very good care of the car? Uh, I mean, I I bought the car 5 years ago. I paid $50,000 for the car, so it's a very good car. It's like BMW, five something I, 530i or something like that. It was $50,000 when it was new. I paid 50,000, and I took very good care of it. I changed oil every 3,000 miles, and I didn't put that too many miles on it. It's 5 years. It's been 5 years, but it has only 5,000 miles on it. It doesn't even have 10,000 miles on it. So it's practically in mint condition. So what should be the depreciation? Shouldn't it have depreciated very little? Very little. Um, yes, if it is your car, if it is your car, personal car, the depreciation you're talking about is the resale value when you put it on the market. Isn't that right? If it is your personal car, the depreciation you're talking about is the actual depreciation, which corresponds to the actual wear and tear. That's what you mean by depreciation if it is your personal car. Right? Isn't it right? And if you put it on the market, you want to get the best value because this car is still in mint condition as far as you are concerned. It has only 5,000 miles on it, and it is, everything is still new. Oil change was done every 3,000 miles. That means if it has only 5,000 miles on it, there was only one oil change. It has had only one oil change so far. It's been like taken care of like your own baby. Every time you took it to the car wash, and every time it was meticulously waxed and detailed and everything. So you think if you take it to the market today, you may not get $50,000, but you would get at least $40,000. You think, you hope, right? And maybe if it is in such a perfect condition, you may get probably very good value. I mean, compared to the average. The same model, same year, same model, same make, but in average condition, right? Compared to something like that, you would get much better, price on it, right? Much better value on it, and that's what you think is the depreciation, isn't it right? That's what you think of as depreciation. So it must have depreciated only very little because it's still very good condition, mint condition, etc. But that, if it is a company car, no, that's not what they mean by depreciation. Okay, so we have to make clear distinction. When you talk about your own car, it's a personal vehicle. It's not an asset. It's not a business asset. It's just your personal vehicle is not a business asset unless you are self-employed and you use it for your business. but then you can declare that as your business asset. But if it is personal asset, there it's not a personal vehicle. It's not an asset. Okay, as far as IRS is concerned. So from with the tax from tax perspective, right? From tax perspective, there is no your personal car doesn't give you any tax benefit, tax deduction, right? But the company car is a business asset, and it will give you uh, tax deduction, right? Because it will be written off as business expense, right? But then your personal, so basically think about it. The insurance on your insurance on the company vehicle, the maintenance on your company vehicle, the gas you put into the company vehicle, these are all business expense, and they will all be part of the operating expenses. So you remember, if operating expenses go up and CGS go up, any expense goes up, that will reduce. That will make the EBIT smaller. If EBIT is smaller, EBT is smaller as well. If EBT is smaller, then taxes will be smaller. Make sense? So that's why depreciation of the company vehicle or business asset follows artificial schedule. It doesn't really matter what condition the car is in. You understand? Your personal car, you want your personal car to depreciate as little as possible, right? So what does that mean? When you resell it, you get so that you can get the highest price on it, right? You don't want your company car, you don't want your personal car to be to depreciate to zero or to scrap metal value. But if it is a company car, company vehicle, you want it to depreciate to zero or scrap metal value. Why? And the reality isn't really like that. You understand? Company car is also well taken care of, right? It may not be taken care of like your baby, right? If it is your personal car, you may take care of it like a baby, right? I know. I used to be like that when I was much younger. My car, really took care of my car like my own baby, right? But the company vehicle is, the company vehicle is still well taken care of. I mean, in the past, these days they don't. I don't know if they have motor pool, but because they don't necessarily have maintain motor pool unless it is like a transportation trucking company. But in the old days, all the companies had their own motor pool, and they had company vehicles, and the company vehicles were taken care of professionally by mechanics who work for this company, right? These are and so company vehicle is relatively well taken care of, but and then so the company vehicle is now 5 years old, so uh, and usually there's a preset or predetermined service life. So I'm gonna have to use another one. Predetermined service life. That means regardless of and the service life of a car, right? Automobile is usually 5 years. 3 to 5 years. I mean, and that is not that is not that is already determined by IRS, right? I mean, IRS gives uh, this depreciation schedule, and by that, service life of automobile is like 5 years. What does that mean? At the end of year 5, this car has completely depreciated. And what does that mean? If it has completely depreciated, then the book value at time 0, right? That's when the car was first bought. Let's say it was 50K. But the book value at the end of year 5, so book value at the end of year 5 should be either 0 or scrap metal value. Right? Think about it. At least what does that mean? Over 5 years, according to this service life, the car has completely expired or disintegrated. If you think of it this way, if you have an eraser, right? Car is not like that, but if you have an eraser, and if the eraser is the business asset, when you use the eraser, right, it will wear out, isn't it right? It will completely wear out, and there is nothing left. When you completely use it up, it's worn out completely. There is no eraser left, isn't it right? So the concept is like that. If it is completely if it has completely depreciated, it should have completely disintegrated, right? It should have completely disintegrated. So, but in reality, it's not like that. We all know. In reality, the car, is, the company car, at the end of year 5, is still fine. They took very good care of it, and in the resale market, they will get some median value, right? Median value for the same model, same make, for the same year. Does that make sense? So in reality, although it can be resold, it can be sold at some good price on the book, on the balance sheet, it should completely reduce to 0 or scrap metal value. And the scrap metal value would be something like probably $100. I mean, if your car got into an accident and send it to if it's totaled, so it goes, you send it to the junkyard, you probably get about $50 or $100 for the scrap metal value. I don't know. So that's the idea. In other words, in that sense, the depreciation of the business assets is artificial. Okay? It doesn't reflect the actual depreciation, but it goes down by artificial schedule. So at the end of, usually if it is 5 years, then at the end of year 1, it falls by, it becomes 40K, falls by 10K each year, right? And the reality may not be exactly like that, but it has to be on the book. It's like that. And why do they do it like that? It takes. I'll have to. It's 4:12 already, so I think this is a good time to take a break. And we'll first take a break, and when we come back, we'll talk more about it. Actually, we want to do. I wanted to accomplish more today, because the homework 3 has been already assigned. But if we can't accomplish what I already intended, then we'll have to do it on Monday. But then you must submit it by Monday, so maybe I can, if that's, then I will accept Tuesday. But anyway, let's take a break first, okay? Let's take a 10-minute break and reconvene at like 4:25. All right, we're back. We're back. Um, so right before we went into break, I thought I saw like 12 people here. Okay. Uh, I think they got disconnected or and then they are coming back now, joining back. All right. So, oh, I forgot to put on my headset. If someone was calling me, I wouldn't have known. Okay, so now we understand more about depreciation, right? Because uh, it's not just uh, decreasing the value of the asset, and there is a whole another side of the another aspect or another side to depreciation, which is basically tax related. Um, but that we can't we don't have time for that. And topic 6 is all about depreciation. So when we get to topic 6, then that will be the time to talk more about it. The uh, the tax aspect of depreciation. Okay, so one thing you need to remember at this point is that the depreciation of business asset follows an artificial schedule. Artificial. It's not natural depreciation, right? It follows the artificial schedule. All right, and then let's go back to our example. And what is this? I didn't open that. What's happening? Okay, so a lot of things are just slowing down. They're using up the computer's memory, the resources, and it's slowing down. Wait a minute. Why did I? Okay, so here, now you see why depreciation is negative, right? The parenthesis means negative, right? Or cash outflow. First of all, there's a good. This is not a random number. I calculated depreciation this way. First of all, uh, depreciation of the physical assets. So I summed these two items, right? Plant and equipment, land and build. But first of all, land doesn't depreciate. Okay, land doesn't depreciate um, because think about it, land doesn't wear and tear, right? Land doesn't depreciate for whatever reason. I mean, uh, if you know anything about farming or agriculture, you would also know that the land loses its the soil loses its what should I call it, fertility, or I mean soil has all these nutrients for plants, but if if you if you grow crops or whatever on the land, if you use the land for agriculture over and over without any interruption, without stopping, without any gap, right? Year after year, you just keep using grow uh, crops in the land without any gap, then the soil loses its nutrients, right? Maybe you can, if ever, that can be considered depreciation, right? But interesting thing is, land doesn't depreciate, and then in accounting rule, land doesn't depreciate, but then somebody might claim, oh well, the soil loses its nutrients, so it loses its productivity. So can that not be considered, depreciation? No. Why? Because if the land loses, the soil loses productivity, then you leave it to rest for a year or a couple of years, or you fertilize it. Land gains the productivity again. So it's not like, but think about it. Production equipment like plant and equipment, production equipment like plant, and the production equipment. What I'm saying is, I'm just tongue-tied now because my mind is in a rush. My mind is actually chasing with time, but my tongue isn't catching up with that speed. So my tongue is twisted. So what I was trying to say was that the physical assets, like plant and equipment, of course they depreciate to the scrap metal value. I mean, if you keep running the equipment, eventually they will turn into a zero or scrap metal value, right? And think about it, the building too. If you don't, the building needs maintenance, and if you don't do that, if you just keep using the building, uh, you have to replace the pipes, plumbing, and heater, and things like that. You have to replace the roofing, and after some years, all those things. If you don't do that, that's maintenance. And if you don't do that, the buildings do, not only depreciate, but they dilapidate. Buildings dilapidate, right? That's losing value. Depreciation. That's completely depreciation. But so land doesn't depreciate, but ignore that because we don't know how much of this is land. Maybe there's no land at all, but basically they depreciate. Sum of you sum those two things, and then why 1 over 15? Why multiplied by 1 over 15? Once again, I don't like to do it like this. This is called, hard coding, right? You don't input any number. You don't input any number manually in the formula unless they are given input data. I mean, given input data, you have to input. You have to manually input these, given data. But something like this, you don't. To do it right, I must have a depreciation schedule next to me, and at least if not depreciation schedule, at least the table that has the calculated result of depreciation and annual depreciation amount or quarterly depreciation amount and service life, and the ratio, depreciation ratio. I should have the table next to this, or then actually point to that number in that separate table. But I didn't have time for doing that before, so I just did it like this. But if I were to do it again, I would. So what is this? This means annually the depreciation rate is 1/15, right? Annually the depreciation rate is 1/15. That means it's a 15-year asset, right? Plant and equipment. They are long-term assets, so they are generally defined as 15-year assets. Sometimes it can be shorter because from the company's perspective, they want to depreciate it sooner rather than longer. And this is why you have to understand that the depreciation of business assets is artificial. You have to understand that, because if it is your own personal vehicle, think about it. If it is your own personal car, do you want to depreciate it fast? Hmm? Do you want, actually, it should be put, you cannot say, you don't, you cannot say, you want to depreciate the car fast. Because you can't make it depreciate. Uh, of course, if you drive it very roughly, if you handle it very roughly, right, you can make it depreciate fast. But you don't want it to depreciate. You don't want your own car to depreciate fast. Isn't that right? Hmm? Doesn't it make sense? I mean, if there's anyone listening to me
Yeah, we're
in
listening.
your, yeah, in your in any in any possible sense, you wouldn't want your car to depreciate fast, right? You want your car to maintain as high value as possible, right? That's the personal car. If it is company vehicle, you want it to depreciate ASAP. Why? It's all because of the tax reason, right? It's because of the tax reason. You want to write it off as expense, so that it will uh, uh, reduce your taxes. It will make your taxes smaller than it really should be. The actual company vehicle may still be very good, and you can still, if you put it on the market, you can still get like probably $30,000. It's been 5 years, and when you bought it, when the company bought it, it was $50,000. But even 5 years later, you may still get it. You may still sell it for $30,000 in the market. But that has nothing to. That is the reality. But the depreciation has nothing to do with the reality. It's just artificial. Okay. So. Um, Plant and equipment is like 15-year assets. So I multiplied it by 1/15 to find annual depreciation amount, and then times 1/4. Because we assume that this is quarterly schedule, quarterly statements, quarterly. So again, uh, it's kind of I don't know if there's any point to that, but I would put uh, forget it. It will just take time. As I said, I wouldn't manually input these numbers in the formula, right? Where's the okay? So now you see why that is the and then you sum everything. It becomes then we got total non-current assets. Then now you think, oh, then we can easily find the total assets, because total assets is then total current assets plus total non-current assets, right? That's the idea. But then we have to there's something we have to verify. Why? By definition, total assets must be equal to the total liabilities and equity. Isn't that right? So then, if let me first try this. If I did it already here. If I add those two numbers, okay, so I'm going to have to. Okay, and then there is nothing here, so I'm going to. And then I also did it here. So here's the, oh, no, not that. I have this number missing, so I'm gonna, so we also needed, okay. Find the auto sum. Total non-current liabilities, and then, oh, equity. Where did the equity come from? Was the equity F7, F12, F15? Or you can do, okay, I'll take care of it later. But I think the equity was probably given as 4 million. Let's say if equity was 4 million, and something weird is that these things should be, numbers must be right aligned. I don't know why it is aligned this way. Okay. Okay, here's the thing. By definition, right, total assets must be equal to total liabilities and equity, right? Then I put total equity, total assets here first, which is what? Total current assets plus total non-current assets. So then it is like this. This is, total assets by definition, right? Current assets plus non-current assets. But then that next, is it equal to total liabilities plus equity? If it isn't equal to that, then we are in trouble, right? Isn't that right? So take a look at, I found total liabilities and equities here. You just saw that. That's total liabilities. This is equity, right? And then, of course, total liabilities is the result of summing these two, right? Total current liabilities plus non-current liabilities. And it gave me this. Now, think about it. The balance sheet doesn't automatically balance itself. Isn't it right? There's no reason it would automatically balance itself. It is your responsibility, right? If you are the accounting manager or something, some in position like that, it's your responsibility, right? It is your responsibility to make sure that they balance out. And of course, if all the data, all the input data are up to date, if everything is up to date, everything is impeccably up to date, no error in the data, it will, right? The asset side and liability side will should balance out. Of course, that's an ideal situation. But if not, there even but in reality, even if all the data you got, you try to get the most up-to-date data, but sometimes some data are delayed. I mean, there's a time lag for certain data to be, completely, updated. So as of the time you uh, made this report, some data may be still missing, or there is some uh, statistical discrepancy. Um, in other words, the data available at the point may not be, the data points available at that point may not be the perfect ones, most up-to-date ones. And then inevitably, the balance sheet may not balance out, right? So something like this may happen. Something like this may happen. So then what do? That's why you have this account called, I named it miscellaneous adjustment, but actually the better name is other assets or miscellaneous assets. Maybe let's rename it miscellaneous assets or other assets. Now think about it. The term, by using the word miscellaneous, that means these are very minor, minuscule things, right? That don't need to be detailed. That don't need to be itemized. We just lump them up all together as miscellaneous assets or other assets. But what it does is actually that the adjustment, that is the adjustment line item. So this also, I can call it miscellaneous liabilities or other liabilities. Okay, usually the name is other assets, other liabilities, but they are basically miscellaneous line items that are just lumped up together. But then you can use this for adjusting the adjusting balancing out both balancing out the balance sheet. So here, obviously, if there is, this is a problem. If you think think about it. This is the total of liabilities and equity. In other words, this is the capital raised. This is the capital. This is the source of the capital. This capital came to our company. We either borrowed or we got it from shareholders. The company got it from the shareholders. So the company owes this capital to the shareholders and the lenders, right? So the company should keep track of. The company has obligation to keep a very good track of this capital, so that at the end there should be, the assets must be either greater than, assets must be greater than the liability side, or the source of the capital, original source of the capital, right? So basically, the initial liabilities, initial debt and equity are paid in capital. You understand? Paid in. They paid it into the company, right? Creditors and the investors paid that capital into the company. So at the end of the operating cycle, in other words, at the end of the first quarter or at the end of the first year, total assets must at least be equal to, or greater than the liabilities and equity. If it is less than the liabilities and equity, you are really in trouble, because you can't explain what happened to, that's almost like $400,000. The discrepancy is almost like $400,000. Isn't that right? And you can't explain it. And if you're the responsible person, I mean, you are like, some accounting manager or someone responsible for keeping track of that, and you can't explain it where it went. Why, there's a discrepancy and where that discrepancy went to. If you can't explain that, you're in trouble. You can lose your job. Why? Well, you can even be, you know, you can even be accused of embezzling the company fund because it's you're under responsibility and it evaporated. You cannot just say, you cannot just tell your, the top management or to the board of directors, you cannot just tell the shareholders, it just evaporated. I don't know. Well, if you say that, then you get fired. Not just fired, you may be sued, right? You may be sued for embezzling the company fund or mishandling or, right? You understand how serious it is? You cannot say, I don't know. When you're in that position, you cannot say, I don't know. You cannot say it just evaporated. And even if it evaporated, then you are accountable. You are held accountable. That means you can go to jail even for that, right? If you're found guilty, I mean, you have to cough up that $400,000. But let's say if the discrepancy is something like that. Look, this company's total asset size. Look at this company's total asset size, almost about $10 million, almost about $10 million, right? So $400,000 out of 10 million is almost like 4% of the company's total assets, right? 4% of company's total assets. Then if 4%, something like that, 4% of the company's, you cannot just sweep it under the carpet. I mean, this is like the carpet. If it is a minor amount, like only about a few $1,000s, or only about less than right? This company's total asset size is 10 million. So if it is there is no line there. I mean, 1% is good enough. No, there is no line there because 1% of 10 million is still what? 1% of 10 million is still 100,000, right? That's somebody's annual salary, right? So you cannot say it is insignificant. But let's and also, so is 0.1% good? Yeah, 0.1% is then of 10 million is just 10,000. For the size of this asset size of this company, that may be acceptable to be just labeled miscellaneous assets. So 0.1% is good. But think about it. You scale it up to if the total asset size of this company is 10 billion, right? If the total asset size is 10 billion, 0.1% of that would be 10 million. Isn't that right? 0.1% is 10 million, right? 1% of 10 billion would be 100 million, right? So 0.1% will be 10 million. So it's not the percentage, right? You cannot just draw the line. What is acceptable as miscellaneous assets? Huh? It's not percentage. You cannot. But it really, if it is really insignificant amount, like less than 10,000, you can put it under miscellaneous, and we can automatically make Excel automatically adjust that. In other words, you think, oh, so okay, because liabilities and equity side is greater than the total asset side, we will just put like $400,000 there. I mean, let's say 400,000 is obviously not an insignificant amount, but if it is a very small amount, like less than $10,000, then we can just fill the gap, right? The side that doesn't have the side that has smaller amount, we'll need to use this line item for adjustment, right? But then you might, okay, so what I do is I take the difference between the two and I fill that there. Yeah, that's basically the idea, but you don't do that. In other words, you don't, how many times did I tell you? You don't manually calculate anything and manually input that. You don't manually calculate anything and manually input anything into Excel. Unless it is initial input data. These are initial input data. They are given. So you have to enter it unless it is automatically downloaded. If it wasn't downloaded, you'll have to manually input it. How else? But, so think about it. If it is what you need to put in there is the difference between the two. What you can do is, see what I did here. You remember the if command? We talked about if command yesterday when we did tax computation, right? EBT, earnings before taxes can be negative, but if it is negative, you don't. There's no tax to pay, so there's no tax to pay. So taxable income. Taxable income is zero, right? Taxable income is zero. And you can, using if command, right? Using if command, you can automatically make Excel automatically pick, right? Automatically judge what the discrepancy is and where, what to do with the discrepancy and which side to, fill that gap. So basically, by using if command, you remember the point is this. So if this side, asset side, is smaller than the liability side, so G16, if C16 is, you remember I put just tentatively total assets there. In other words, current assets plus non-current assets there. You make Excel compare that with the G16. Okay, and if that's the case, comma. I told you first comma means and. If that's the case, then do this in there. Put that the difference. Put the difference between G16 and C16 in there in that B16. Otherwise, second comma means, I told you the second comma means otherwise. Otherwise, nothing to do. Leave it blank, right? Leave it as zero or leave it blank, right? And so it did. So it did, right? And we do the same. We use the same, but the counterpart logic this time. If this side is small. So now, because you have something to do, you have something to fill in there. If that item is smaller than the other one, right? So it's the counterpart logic. If G16 is smaller than C16, there is something to do, right? Isn't that right? And the first comma is and, I told you. Take the difference between C16 because, if that is the case, C16 is greater. C16 minus G16, right? That means put that number, put it in there in F16. Second comma means otherwise. Otherwise, leave it blank. Nothing to do. So leave it blank or put 0 in there. So if it, by doing that, it automatically picked 0 because that's the case. And finally, then total assets. To find total assets, then what do I need to do? Then total assets is then total non-current assets plus total current assets plus total non-current assets plus miscellaneous assets, right? Sum of those 3 line items, enter, and then it's balanced out with the other side, liabilities and equity side. So here too, then the sum is then the total liabilities and equity is total liabilities plus equity plus miscellaneous liabilities, right? And then hit enter. They balance out. Okay. Now numbers should be all right aligned, but why? This is crazy. Okay. So this way, you can have Excel automatically balance out the balance sheet. And of course, it's never too much to emphasize. Again, okay, after it is done, because that cell was for your own reference. So after it's done, you can simply collapse. You can simply collapse that column, so it won't show. I mean, it doesn't. You don't have to show that. You don't have to show that to the audience, right? But when you submit the homework to me, you need to show that to me. But even if you don't, I can, as long as you have done that, I can look into it, right? It's never too much to emphasize. I mean, it's never too, what should I say? Never too much emphasis. It's never too much emphasis to say that you can do it only with a very minor amount of discrepancy. You understand? If it is, if it is significant amount, you can't do it like this. You shouldn't. You should really track. You should really trace the source of the discrepancy, and you should make up, right? In the miscellaneous assets, you should actually, have the right number. I mean, in other words, it's not just this, but in every line item, you should trace where the what is the source of the discrepancy, and you have to correct it all, right? You have to update all those data so that even without miscellaneous, if there may be really miscellaneous line items, miscellaneous assets, but if the even without but unless that's the case, and miscellaneous assets, as I said, if there are no miscellaneous assets, then this can be used as a simply solely for that adjustment purpose. But again, it has to be a small amount, very small amount. If it is significant amount, and you cannot just say this is miscellaneous assets or other assets, right? You have to really trace it back to the source of the error and update the data so that with the minimal adjustment, it will still, the balance sheet will balance out. Okay, and usually the case is, if the company has been doing well, then you will have more total asset. You will have greater total asset. It will come out as then uh, the liabilities and equity. But of course, that's wrong, right? That's wrong. Why? Balance sheet must balance out. They must balance out. Otherwise, it's wrong. So, but it is possible. Why? If the company has been doing well, uh, their assets must have increased. But then that must be also reflected in the liabilities and equity side, so that they should eventually balance out. If they don't balance out, they are not balance sheet, right? That's the whole idea. Okay, so that's all the time we have today. I was hoping to do this exercise today, but we couldn't. We needed to do this exercise, a further exercise actually, further exercise. We should have done this. Um, uh, but it's not that difficult, horizontal analysis and vertical analysis. This is vertical analysis and horizontal analysis. It's nothing. It's just the percentage of each line item out of the total assets, right? In other words, you're expressing each line item as percentage of the total assets. This, also horizontal analysis. So we'll have to do this on Monday. Okay. Alrighty. So that's it for today. If you have any questions, please email me. Uh, so have a great afternoon, everyone. Are you guys there? Did you hear me?
Yes, thank you, Professor.
Goodbye, Professor.
Take care now. Take care, everyone. All right, stop recording. I'll see you guys on Monday. Okay.